7/14, 2013, Sunday morning, time 7:41 a.m. Pacific Standard Time. We have Priceline.com making huge all-time 52-week highs. The last time that we were over here at 860, let's just call this high right here, this reversal high. Let's just call it that we were at 719 on the 50-day moving averages way back then, and we've gone $100 higher. What I really want to say on this particular chart, when we were up here at 846, 850 level, we pulled all the way back down here to the lows of around 788, and we consolidated here on this daily chart. The last lows where this doji is at 797. We've gone from 797 on the lows straight up to 920. The stock is grossly overbought, 100% overbought. You can see where this last bull rally, where we have just gone parabolically up, money came off the sideline, obviously, and here is that weekly. It's 3 weeks, just like with the broader market. One thing about today's updates, you're going to notice what the last 3 weeks were. So the last 3 weeks with the 10-week moving average coming into play, that low right there was down here. Let's just call it close enough to 792 to 920. Fresh highs, overbought. Stock is going to have a correction. We'll be looking at the put side of the market to make money in the very short term. Huge bull run on Priceline. They came out, put $1,000 price targets on this one too as well. And I'm saying you got to know when to sell into it. So when it comes to the call side of the market, the calls have got the big move, big money made there. But the put side is the side that we have to look at, because we're at 52-week highs. That means that the put side of the market is at all-time lows. That is where the least amount of risk is to make a transaction, to be in this trade, is to get the right strike prices. We're going to look at the $900 strike price. We're going to look at the $910 put strike prices. And we'll even look at the 880s back here where that weekly move went up. But we prefer to get the upper strike prices. They're deflated, totally deflated. To give our traders around the world, this is a Priceline $910 put, $910 strike price. It expires on 7/26. What I will talk about, that when the put options were up here, and it's a weekly now, let's make sure that you understand the weekly. The weekly was up here at $34. It's down here at $13.50. That's extremely deflated. Okay, if I show it on a daily level, you can see here how they gap these contracts all the way down. This is the put side. That's $10 below the current 52-week high of the 910s that we're going to look at. When it comes to trading options, we encourage you to get involved, because here is a $900 put. It's a weekly as well, and they were $23 a contract. They've come down to $9.90. This is the side of the market that we're looking at. If I go to the monthly expiration, which is a June regular monthly, and I come in here and I scroll down here all the way to $910, we're going to see what the calendar 720 looks like. We are going to look at trading this side of the market, because this is where the least amount of risk is, and this is what the put side. The strike price is $910, so we're going to look at this, because this is where the least amount of risk is. They've been marked down totally. Now, if I show you something on the opposite end, let's say we take the $900 call. And the $900 call that was down here at $2 or less than $2, it's up here at the very high. That's called inflated. They're going to come down. Just like when the calls at this point, back over here on this date, it was 521 when we called for a broader correction in the markets and Priceline. I mean, the calls were up here. Look at how high the calls were. They were $24. I mean, at this point, they were opening up at $13.52. Then they went down here to the lows. This is what happens. They went down here to the lows of 70 cents from 13. When they get inflated, they come down. They're inflated. That's why it's very important that our new traders and everyone understands why we're looking at the put option is that the $910 put is down here at the very bottoms. And once again, Priceline, the equity, and we're going to be covering a lot of these things going into the earnings, because I can tell you that if you're going to buy calls up here at the highs, going into earnings, you're going to get taken to the woodshed and you're going to just lose a tremendous amount of money. The side of the market is the put side of the market. The calls have already made their money. Amazon's 100% overbought. That's the 920 we're looking at, and we'll look at 920 strike prices as well. I can show it very quickly here. Here's a 920 for the regular. Let's make sure I have the right one. Yeah, here it is. It's a different type of contract. This is a daily chart. So we can clearly see that they're marked down to $12. They were here at $100 a contract, $105 a contract. So from $105 that these put options were worth at the night, they were called deep in the money. So they took them all the way down here to $12. That's over $90 drop. So from 105 down here, this is the side of the market that we're looking at trading Priceline. We will make a very successful trade, and we will make sure that all of you around the world and in the USA are all updated as this trade goes down, because it's very important that there's a time to sell the long side, the bull side, and there's a time to buy some of the bear side, and using the options is the best way to go, because that is the cheapest side of the market with the lowest dollar amount capital risk.